So I'm going to be going over a less common funding source for multifamily, but still a great tool that is used to finance a lot of different types of commercial assets, including multifamily sometimes. And that is the CMBS loan. So CMBS is a commercial mortgage-backed security. And I'm going to be going over what it is, how it differs from other traditional loans, what are the pros and cons, and then when is a good time to be able to use this financing product. So let's get into it. Before we talk about CMBS loans, let's talk about how traditional banking relationships work. Typically, if you're going to have a loan at the bank is going to underwrite you. They're going to underwrite you and your asset, and then they're going to approve or deny, and then they give you a loan if you're approved, and they're going to hold on to that loan long term. Now, because they're holding on to that loan long term, they're carrying the risk, and they're going to underwrite you pretty carefully because they don't want to carry the risk of a asset that won't perform. So they're going to be very careful. Now, once you have this loan and you have this mortgage with the bank, if you run into an issue with financing, say you're struggling, you might not be able to pay the loan, or you got to miss some months, you can call up that bank, and then you can maybe negotiate some kind of forbearance, maybe able to just see what your options are. But you can talk to the bank because the bank has that loan. Now, in the case of a CMBS loan, a commercial mortgage-backed security, what the bank is going to do is going to start off pretty similar. They're going to underwrite you in the asset, and then once they approve you, they're going to give you that loan, and then they're going to sell that mortgage. They're going to package it with other mortgages, and they're going to put it into a bond and then sell it to investors. That's what they mean by commercial mortgage-backed security. So now you're looking at like the capital markets. You're investing, or you have investors that are investing essentially in debt in the form of securities, and those securities are backed by commercial mortgages. So the bank, again, they package your loan along with a whole bunch of other loans, and then they're going to sell it on the bond market to investors. Now those investors have your mortgage, and that mortgage is a part of a bond with a whole lot of other mortgages. So now in this case, the bank no longer has your loan. So if you run into an issue trying to pay back that loan, you can't just call up the bank. Now that your loan is part of a bond with a whole bunch of other loans, and now the investors have it. So now you can't just call it the bank, like, essentially you don't have the same freedom or kind of flexibility when it comes to loan servicing with a commercial mortgage-backed security, because the bank that you went to no longer has your loan. The upside though, or one of the benefits, because the bank that underwrote you isn't going to be carrying the risk long term, they may not be as rigid in their underwriting. So they may be a little more flexible in how they underwrite the loan because they're not going to be carrying their risk long term. So that's the pros and cons, or that's one of the trade-offs is, you have a less stringent underwriting process, but then you have less flexibility when it comes to actually, the loan servicing. Now, why do investors want to invest in commercial mortgage-backed securities? Well, it's mainly two things. One, they get, steady income in the form of mortgages, and two, they get diversified risk because it's not just, your loan that's within the bond. It's a lot of different loans. So if you default, a few other people default, it's not that big of a deal when there's, a whole bunch of other loans that they've invested in. So, that's the benefit to investors and why they purchase these commercial mortgage-backed securities. Okay, so what are the benefits of getting a commercial mortgage-backed security? For one, the flexibility in asset type. So you can use them for office, retail, industrial, multifamily. So, a lot of the finance I talked about, like you go to agency, Fannie Mae, Freddie Mac, that's specifically going to be for multifamily, residential housing. Is not going to be able to be used for like commercial assets, but CMBS can be used for those. Another benefit is that they're non-recourse. So, I mentioned that in the intro to debt servicing video, where, there's recourse versus non-recourse. These are non-recourse, so there's not personal liability. If you default, the bank can't come after your personal assets unless you like do some fraud or something. And then third benefit is they have competitive fixed rates, so you're not having to deal with floating rates. You got fixed rates, and they're competitive with other loan products out there. Now the downside is, as I mentioned earlier, the rigidity in loan servicing. You can't, get some forbearance or try to restructure things, or it's very difficult to do so, because the bank that underwrote you does not have your mortgage anymore. And then the other downside is that rigidity extends beyond like a forbearance. Say you want to get like a refinance. Say the interest rates drop, 2, 3 years into your loan, and you want to try and refinance to get a lower interest rate. It's going to be very difficult because, again, your mortgage is now with an investor, and that investor purchased your mortgage or invested in your mortgage along with a whole bunch of other mortgages. So it's not just you, it's you with a whole bunch of other mortgages. And then they invested with a particular rate because they wanted to get a particular return. So if they got you at 5% and now you're trying to, refinance it to 3%, the investor's like, I wanted 5%. I invested with the expectation of getting 5%. So you trying to go 3%? Yeah, you can't. That's not gonna fly. It's not gonna be that simple. Now on the flip side, if you refinance to 7%, that's something that there's different options there. But essentially, there's more rigidity in the loan servicing. You don't necessarily have the same options that you would with other loan products. Okay, now when should you use a CMBS loan? So it's good for long-term holds. So if you're not trying to get into an asset and then get back out in a few years, like if you're not going to do value add play, fix up the value and exit quick, it's good for that because again, it's rigid loan servicing. Once you get that loan, you're kind of locked in, and it's possible, but it's difficult to try and get out of it or be able to transition. So if you want to stay into a asset long term, a CMBS loan can be good, especially if an agency loan is not available for what you're trying to acquire. It's also good for getting assets that are not multifamily. So if you got different type of asset, office space, retail, industrial, this can be a better option for you than trying to go agency that's specifically for multifamily. So to wrap things up, CMBS loans are good for just adding another tool to your tool belt and expanding your options. So, beyond just having agency or bridge, now you know about the CMBS, and that allows you more flexibility. All of these, understanding all these different financing tools is like just adding more tools to your tool belt. And the more tools you have in the tool belt, the more problems you can fix. And in this case, the more deals you can close because you have more ways and strategies of being able to close this deal. All right. So if you got some value out of this, please go ahead and like and subscribe, comment, share with somebody. Be on the lookout for more videos and talk about more financing and other tools and just commercial real estate. That's what we hear about. All right. Till next time. Take it easy.